Imagine spending years putting your hard-earned money into the stock market, only to realize that you've been playing the wrong game all along. You weren't losing because the market was against you. You were losing because of small mistakes that quietly ate your returns. The truth is, most investors don't fail because they pick the wrong stock. They fail because they repeat the same patterns that almost every investor falls into, especially in the beginning. We all dream of being that person who bought Apple or Tesla before the boom. But for most of us, investing isn't about luck, it's about mindset. And mindset is where most people trip up. Today, we're breaking down the 10 mistakes that nearly every investor makes at some point. And more importantly, how to avoid them before they cost you years of growth. Let's start with the first and perhaps most common mistake: trying to time the market. It sounds smart. Buy when prices are low, sell when they're high. But if that really worked, everyone would be rich. The problem is, no one can consistently predict short-term market moves. Even professional fund managers with decades of experience fail to do it. The data proves it. Over 90% of active traders underperform the market in the long run. Why? Because they let emotion make the calls. Fear when the market drops, greed when it rises. It's the same story, repeated endlessly. The better approach? Time in the market beats timing the market. Consistency, not prediction, creates wealth. The second mistake: investing without a plan. Imagine driving without a destination. You'd waste fuel, time, and probably end up lost. The same goes for your money. Most people invest randomly. They buy a stock because they saw a headline or their friend mentioned it, or it looked cheap. But investing without goals is like shooting arrows without a target. A plan doesn't have to be complicated. It simply means knowing what you're investing for: retirement, a house, financial freedom. Once you define that, you can choose assets and time horizons that fit those goals. Without a plan, even the best investment can feel like a mistake because you won't know when to buy, hold, or sell. Mistake number 3: panicking when prices fall. Market crashes aren't a bug, they're a feature. They happen, on average, every few years. And yet, every time it happens, investors react the same way. They panic. They sell at the worst possible moment, locking in losses that could have recovered with time. Think about this. If you invested $10,000 in the S&P 500 in 2008, right before the financial crisis, and never sold, by 2023 that same investment would be worth more than $40,000. But if you sold out of fear and waited a year or two to re-enter, your returns could be half of that. The market rewards patience, not panic. Fourth mistake: not diversifying enough. Diversification is a fancy word for not putting all your eggs in one basket. It's about spreading your risk across industries, asset classes, and sometimes even countries. When you put too much faith in one stock or one sector, you're basically gambling on luck. In 2000, during the dot-com bubble, people thought tech stocks would rise forever. Then the bubble burst, and some portfolios lost 80% overnight. Those who had a mix, maybe some bonds, real estate, or stable dividend companies, didn't just survive, they recovered faster. Diversification doesn't guarantee profits, but it protects you from disaster. Mistake number 5: ignoring fees and taxes. This one's invisible, which makes it dangerous. You might think a 1% management fee is small, but over decades it can eat a massive portion of your profits. Let's say you invest $100,000 for 30 years, earning an average of 7% annually. With zero fees, you'd end up with about $760,000. But with a 1% annual fee, you'd have only about $575,000. That's $185,000 gone, just in fees. The same goes for taxes. Selling too often or ignoring tax-efficient accounts can quietly drain your returns. Smart investors think after tax, not just pre-tax. It's not how much you earn, it's how much you keep. Now, mistake number 6: chasing hot tips and trends. It's tempting. Everyone's talking about a new stock, a meme coin, or the next guaranteed 10x opportunity. Social media makes it even worse, turning speculation into a group sport. But by the time you hear about the next big thing, it's probably too late. Take the 2021 crypto boom. People jumped in when prices were at all-time highs, and many lost 70 to 90% of their investment within months. The irony? The people who actually made money weren't chasing. They were the ones who held long-term positions before the hype started. Investing should feel boring most of the time. Excitement is a warning sign, not a green light. Mistake number 7, forgetting the power of compounding. Compounding is what turns small, consistent actions into extraordinary results. But many investors interrupt it by constantly buying and selling. Every time you sell, you reset the clock. Here's a simple example. If you invest $500 a month at 8% annual growth, after 10 years you'll have around $90,000. After 20 years, $295,000. After 30 years, nearly $750,000. That's the magic of staying put. But if you panic or switch investments too often, you rob yourself of that growth. Time is your biggest asset, not your money, not your strategy, just time. Before we go deeper, let's pause here. Because the next 3 mistakes aren't about numbers, they're about behavior. And they're the real reason some people stay poor even after making money. These are the psychological traps that make smart investors act irrationally. The same traps you've probably fallen into without even realizing it. Mistake number 8, believing you can outsmart the market. It's a seductive idea that with enough research, intuition, or cleverness, you can beat everyone else. But the market is a collection of millions of investors, algorithms, and institutions, all processing information faster than you can blink. The odds that you, sitting at your laptop, can consistently outthink them are close to 0. Of course, that doesn't mean you can't succeed. It means success doesn't come from guessing what happens next. It comes from discipline, from sticking to a strategy through both good and bad times. The world's most successful investors, like Warren Buffett, don't beat the market by predicting the future. They win by having the patience to wait while everyone else panics. Mistake number 9, not knowing your own risk tolerance. Investing isn't one size fits all. The right portfolio for a 25-year-old who just started working isn't the same as for a 60-year-old nearing retirement. Yet many people invest without asking a simple question: how much risk can I actually handle? Risk tolerance isn't about being brave. It's about being realistic. If a 20% drop in your portfolio makes you lose sleep, you might be taking on too much risk. Because when emotions take over, logic disappears. Smart investors design their portfolios so that even during market chaos, they can stay calm. That's how you survive the storms and keep compounding through them. Mistake number 10, not investing at all. This one sounds obvious, but it's surprisingly common. Millions of people never start because they think they don't have enough money, or they're waiting for the right time. The problem is, waiting feels safe, but it's actually the most expensive mistake of all. Let's say 2 people each invest $200 a month at 8% annual growth. One starts at age 25, the other waits until 35. By age 65, the early investor has around $587,000. The late starter? Only about $260,000. That 10-year delay costs over $300,000 just from waiting. The perfect time to start investing doesn't exist. The best time was yesterday. The second best time is today. Now, let's talk about what connects all these mistakes. A single theme that quietly drives them: emotion. Most people think investing is a game of logic and numbers. In reality, it's a game of behavior. Fear, greed, impatience, ego. These emotions influence your decisions far more than data ever could. And the market knows it. Every boom and crash is powered by emotion, not information. You can't remove emotion completely, but you can build systems that protect you from it. For example, automating your investments each month keeps you consistent, no matter what the market does. Setting clear rules like, "I won't sell unless my long-term goals change," keeps you grounded when everyone else is panicking. The less you react, the more your money grows. Think of investing like growing a tree. You plant it, you water it, and you let time do its work. But if you keep digging it up every few weeks to check the roots, it'll never grow. Most investors kill their returns not because of bad seeds, but because they can't stop touching them. So what separates the few who build real wealth from everyone else? It's not intelligence, it's patience. It's not timing the market, it's trusting the process. The best investors know that making money isn't about being perfect. It's about avoiding the biggest mistakes and letting time reward you for your consistency. Let's recap. Don't try to time the market. Stay invested. Have a clear plan. Know your goals. Be patient during downturns. Diversify your portfolio. Watch out for hidden fees and taxes. Ignore the hype and trends. Let compounding work uninterrupted. Accept that you can't outsmart the market. Invest according to your own risk tolerance. And most importantly, start now. Because in the long run, investing isn't about beating others. It's about beating your past self, the one who waited, hesitated, or doubted. Every dollar you invest today is your future self's thank you letter. So, take a deep breath, start small, and stay consistent. 10 years from now, you'll look back and realize that avoiding these mistakes was the best investment you ever made. And if you want to keep learning how to make smarter, calmer decisions with your money, hit that subscribe button